Hello, I'm Dick.
And I'm Eric, and we're the Annuity Guys.
Well, Eric, we're always being asked our opinion on
Get your crystal ball out.
which way the markets are going to go, and we're very good at our politically correct answer.
We don't have a crystal ball.
That it could go either way. You know, we've always kind of got a general thought, but we're going to stick our necks out.
We're going to call it this time.
We're going to call it.
The results are in.
Exactly.
We've got the final numbers. We're going to call it right now.
Exactly. And part of the reason that we feel this way is because there's just too many telltale signs of what's going on, and we've waited a long time to stick our neck out. So we don't feel like we've got a whole lot to be wrong about at this point.
Well, the indicators are there, and as we've kind of gone through the history of the history of the market, so to speak.
Right.
If we don't learn from our mistakes, we're doomed to repeat them.
Exactly.
And so the telltale signs are all in, and so we can either choose to make some adjustments this time, or we can,
or believe it's going to be different.
This time it's unique.
Exactly. You know, President Trump's in, and we're just going to keep climbing. You know,
we're going to keep experiencing the Trump bump.
Yes, and not the Trump dump.
Well, and I think we're ready to call the number two. So
I agree. So, well, you know what's led us to this a lot. We read a lot. You know, well read on it, where it's our industry, so we're always looking at it, and we're trying to help our clients. But you know, there's more and more leading indicators, and just recently, you know, we both got on this John Malden article, and he's got about 12 charts out there that really kind of support what's going on and what we feel, and so we'll put that on the post. But let's take a couple of these charts and talk about them. Why don't you want to take the first one?
Yeah. So the first one is kind of the Shiller price to earnings measure. So if you look at historically the valuation of the market, and you look at where we're at right now, we're currently about 30% from a total valuation of the entire market above where we were in 2007.
Well, we know what happened in 2007, 2008. Exactly. I mean, you know, everything looked real stable in 2007, and
so we've got valuations here.
Yeah.
And just common sense tells you, when do you want to buy something? Do you want to buy when it's full priced, or do you want to buy it when it's on sale?
Yeah.
Right now, if you're going into the market, you're buying basically things at full price. You're buying at a valuation that's typically higher than what it has been. So from a historical standpoint,
well, Eric, this is a supply and demand situation. Yeah. I mean, right now you've got just more buyers than you've got sellers.
Yeah. So as people are coming in, and which kind of comes into our next kind of level of measure in the chart that you kind of were highlighting.
Yeah. When we talk about volatility, you know, you would think with price to earning ratios, you know, where they are, you know, like you're saying, you know, about 30% above 2007, and you know, again, maybe only rivaled by a couple of other times in history. So you'd think that volatility would be kind of way.
People would be nervous.
Because things are getting really high.
I don't know that I want to buy anymore.
But it's just the opposite. And
it's time to get in. I'm missing out. I got to get in.
Exactly. And this is where people are at. It's like, look, you can trust the market now. I mean, look how steady and stable it is. You know, so it lures the retail investor in, the individuals. That's what they say. That's always the kind of the end of the run. You know, is when all the retail investors start to pile in. And we've been seeing it for some time now. And now it's reaching that point where we're pretty comfortable that the next shoe is about to drop.
Right. When you look at the all-time low in volatility, and we look at kind of the other precipitating events that are going on, the Fed's going to start to increase rates. It started to happen. They're calling for a couple more. Now, do we know it's going to happen for sure? No. But if it continues to happen, these people that have been forced into the market, you know, and a lot of them being people that are trying to get dividends for their clients or themselves. All of a sudden, we can go to a safer place to get some of those returns. So now we move out of the stock market into the bond market.
You can see it setting itself up.
That's exactly it. It's all the points are starting to come to a peak. Well, and then once that happens,
well, and so really, it isn't such a bad deal. I mean, the key is what do you do when you have this knowledge? I mean, where do you go? What do you do? Because if you know in advance when something's going to happen, you can be okay. You can be one of the winners.
Well, and that's the decision. Do you want to take corrective action at this point in time?
Right.
If you know that things are at a peak, that they're all at the highest point,
Yes.
is it time to take some of the winnings off the table?
Sure.
And in my mind, if you're close to retirement, do you need to start thinking about preservation of assets, not just about accumulation?
Which you should really always be balancing in your portfolio. So, you know, if you've kind of got a second chance, you know, while markets are high, or a first chance, exactly. So we're, you know, obviously we're the annuity guys. So how do annuities...
And we're going to sound like annuity sales guys today, because annuities can work for preservation of assets.
Yes.
And just knowing that you can go to a place where you get a fixed rate of return for a period of time, or even in this case, fixed indexed annuities can work, where you're not sure that it's the end. Your crystal ball is still foggy. Well, and if you want the opportunity to go in, put a safeguard or a floor underneath your assets.
Right, you're not going backwards.
Still participate in some of the upside of the market.
Correct.
You know, that way if it does continue on and we're wrong, then you still participate. But
and you're well positioned either way it goes, because if you're in cash, your money really isn't going to be able to work for you too well. I mean, it's a low interest rate environment.
and I've got clients that have been in cash, that I know of that have been in cash, I should say, since 2008. The problem is, when do you get back in? They've been in cash since they missed the run up.
Right, they're not going to get in now because the market's at all-time highs.
Well, they shouldn't get in now, but now they want to.
And then when you see the market crash, you don't know where the bottom is, and so you're still waiting to find the bottom. And you know, it's market timing. I mean, there's a recent Dalbar study, and Dalbar studies year after year over the last 20, 30 years.
Individual
investors don't. They make average 3-4% tops.
Yeah.
So Eric, I think when we're looking at our prediction, we're really putting ourselves out there today.
We're going to say it. We're calling it today. We're doomed not doomed. We are
not doomed.
We're just due.
We're due in 2017. Yeah, to see a serious correction.